Today we're talking about life insurance for tax-free income. Hey, it's Matthew Decker, Leveraged Wealth. If you haven't already seen video 1 in this series where we overview the different types of tax-free income that exist and why you may want it, I would encourage you to do that. I'll link it here above so that you can check that out. But basically, we talked about that there's really only 3 types of tax-free income. You've got Roth accounts, municipal bonds, cash value life insurance, and I guess the fourth one, bonus, rental income. If you can offset it with depreciation and keep the depreciation train flowing, then that would work as well. But we're going to zero in on life insurance for tax-free income. We're going to start by talking about section 7702 and the taxation of life insurance. Then we're going to go into how you get your money out of these different life insurance policy contracts to keep the money tax-free. We're going to talk about the proper structure of these contracts, the right way and the wrong way to do it. And then lastly, why you haven't heard about this yet. So let's get to section 7702 and the taxation of life insurance. So this is part of section 7702, and you can basically read it right here. It defines what a life insurance policy is in order to qualify as a life insurance contract for federal income tax purposes. And if you want to read the rest of section 7702, I encourage you to do that. But essentially, this is saying that yes, life insurance is not taxable at the federal level, assuming that you follow the guidelines set forth in 7702. And they go so far as saying what you would have to do to break the rules. And that is called a modified endowment contract. This is 7702 continued. So a modified endowment contract is a requirement that is life insurance, but it fails to meet the 7-pay test set forth in 7702A, subsection B. And a modified endowment contract would be taxed similar to like a non-qualified annuity. Your gains come out first, which is known as LIFO, last in, first out, and is generally something that you would want to avoid. But the truth is, the story is much cooler than just talking about section 7702. And it all comes down to these 3 pieces of legislation: TEFRA, DEFRA, and Tamra. So this was 3 different pieces of legislation that came out in 1982, 1984, 1988. And these 3 pieces of legislation essentially cemented the benefits of life insurance in the tax code. And it said that yes, indeed, not only is death benefit tax-free, but if you follow the rules set out in these 3 pieces of legislation, the cash growth is also tax-free. So the first piece of legislation in 82 essentially said that universal life insurance is life insurance. And then the next 2 further defined what had to be met in order for life insurance to be considered life insurance and retain its tax benefits. But what's really interesting about these 3 pieces of legislation is that before they were rolled out in 1982, life insurance was the best tax haven that has ever existed, that will ever exist, because there were no definitions. They hadn't actually defined what life insurance was. And so you could go out and you could put in $1 million into a life insurance contract and buy a $1 million death benefit. Now, I'll say that again. You could put in $1 million in cash for a $1 million death benefit. Why would you do that? Well, the reason that you would do that was because the $1 million that you put into the cash value life insurance contract was not taxable. And if you put in $1 million for a $1 million death benefit, there was essentially no fees in that transaction other than your standard processing fees, because the company's not actually on the hook for any death benefit. You're self-insuring your own death benefit with your own $1 million. But if that contract grows, maybe it grows to $2 million, $3 million, $4 million over the course of 10 to 30 years. Well, guess what? It's in a life insurance contract. It's not costing you anything because you're self-insuring, and it's all tax-free. And you had very wealthy people putting millions of dollars into life insurance prior to 1982, when the laws and the rules were clearly defined, and it was the best tax haven that's ever existed. And what's really interesting about that story is all those people that put all that money into life insurance before Congress had time to define the rules around it, they got to keep their policies and their tax benefits, which is really important because we get questioned a lot on this channel about, well, what if life insurance loses its tax treatment in future legislation? And it's a question I love to answer because that has actually already been tried. It was tried in 82, 84, and 88 when Congress changed the rules around taxation of life insurance. And yet, everyone that had a pre-1982 policy that would not have qualified as life insurance got to keep their policy and the tax benefits. And so the idea that taxation of life insurance and the tax-free benefit of the cash inside life insurance policies, it's kind of already grandfathered into the rules because they've already let people break the rules once when new legislation has rolled out and keep their policies. So if you want to know more, I'd encourage you to check out those three rulings, TEFRA, DEFRA, and Tamra. They're pretty boring to read, and they were done over the span of basically 6 to 8 years, but it cements the tax benefits of life insurance in IRS code and in the laws of our country, and that's why we love it. So let's talk about the most common way that people will get money out of their life insurance policy. And in order to do that, I'm going to share my screen and really quickly just go through the three entities involved in this transaction. There are three accounts when you go to take money out of your life insurance policy. There's you, or maybe your bank account. Okay, that would be the one. There's the policy itself, or the cash value inside the policy. And then there's the actual insurance company. Okay, so there's your bank account, there's the policy account, and then there's the insurance company's general portfolio. Now, the reason that money can be taken out of a life insurance policy without paying any taxes is because you're actually doing so by taking a loan from the insurance company, and they are depositing that loan directly into your bank account. Now, here's a question that every single one of you knows the answer to. The last time you got a loan from a bank, were you taxed on it? No, you weren't taxed on it. And that's the same thing that's happening here. You're taking a loan from the insurance company. They're paying that money into your bank account. And at the exact same time, the insurance company is going to place a lien on your life insurance policy. So they send you the money. They don't take anything out of your actual policy itself. They simply place a lien on your life insurance policy. That lien is going to accrue interest over the years, and eventually you're going to pay that lien back with death benefit dollars. You're going to pay the lien back plus the interest with death benefit dollars. Now, what's really interesting about this transaction is since no money is actually leaving your policy itself, it continues to earn interest on the entire account value. So every single year, you're able to earn interest on your total value of the life insurance policy, even though you might be systematically taking loans every single year from the life insurance policy and every single year, or from the life insurance company, and every single year they're simply re-upping or adjusting the lien against your life insurance policy. You're still able to earn interest on all of that money. So the whole name of the game becomes, can I earn more interest in my life insurance policy than what the insurance company is charging me for the loan in terms of the lien? And if you can do that, you're actually making money on the money that the company is loaning to you. And that becomes a way to really supercharge the amount of income that you can take out of these policies without paying taxes on it, knowing that you're going to pay the lien back plus the interest with your death benefit. And if you can do that the right way, this becomes an income generating vehicle that's not only tax efficient, but it's extremely difficult to compete with unless you are willing to take a whole lot more risk in the stock market than what you would be taking in the life insurance policy. So let's talk about the right way and the wrong way to structure these contracts so you can make sure that you're getting the best bang for your buck, because these can be done wrong and you have to be working with somebody that actually knows what they're doing if you want this to work long term, because these are long-term contracts. So let's go back to the whiteboard here and talk about the right way and the wrong way to do this. Now, we've done a lot of videos on the right way and the wrong way to properly structure index universal life insurance contracts. So I don't want to take too much time to go through that now. We'll link some of those videos above so that you can check those out. But I'll give you a brief overview of how you can go about determining whether or not the policy that you're looking at or the one that you would ask for is designed the right way. And so I'm just going to give you some terminology. There's things that you need to know. So number one, you have to understand the difference between, you have to understand what your premium is, what you want it to be. How much money do you want to put into this contract to generate tax-free income in the future? And you have to understand that the premium that you're paying is going to correlate to the death benefit that you buy. So there will be a minimum amount of death benefit that you have to buy in order to not violate Section 7702 and turn this policy into a modified endowment contract and thus taxable. So there's a minimum amount of death benefit that you're going to be required to buy to keep the tax benefits based on the premium that you're paying and your age and your sex. That's it. That's how it works, okay? So you're paying a premium, you want to make sure you're paying the minimum death benefit. The reason you want the minimum death benefit is because what drives the fees and the commission on the contract, it's the death benefit. So the higher the death benefit, the higher the fees. The lower the death benefit, the lower the fees. So if you want a policy that's designed the right way, you need a policy where you're paying a premium, preferably for 5 years or longer. You need the minimum death benefit, and obviously you want the minimum fees, minimum commission. You want this policy to be with an A-rated carrier that has a lot of track record in this space. Outside of those things, there's a lot of different ways to structure these contracts. And that's why I would encourage you, if you're interested in structuring one of these contracts, you can book a discovery call with us and we can talk about it, or you can check out some of the other videos that I've done on this particular topic. So the last thing I want to talk about today is, why isn't everyone doing this? And so we get that question a lot. Matt, this sounds great. In fact, it sounds too good to be true. Why haven't I heard about it before? Why isn't everyone doing this? And well, what I would submit to you is, if you've heard of this strategy, chances are most people that are your age or income level either have heard about it or will hear about it. And to prove that to you, I pulled here the total value of assets held in life insurance contracts from 1990 to 2018. In 1990, there was a little over $1 trillion held in cash in life insurance assets. Fast forward to 2018, over $7 trillion is held in life insurance contracts in just that short time frame. And so you may think, why isn't everyone doing this? And what I would tell you is, more and more people are looking to life insurance as a safe asset that can grow similar to maybe like a bond portfolio. Personally, I think, and this is my opinion, I think life insurance is actually poised to outperform bonds in the near future. But a lot of people are looking at life insurance as a tax advantaged way to get outsized returns for the risk that they are taking. And so if you haven't heard of this strategy, if you're new to this strategy, I would just tell you that most people start learning about cash value life insurance once they hit income thresholds for the Roth IRA, which is right around $200,000, or once they get over the age of 45, because as you get closer to retirement, you start looking for safer and safer investment vehicles. But just investing in straight bonds or fixed assets isn't sexy enough when you're in your late 40s, early 50s to really entice people to move on that. And so they look at alternative assets, things like life insurance. And at the same time, as you start making more money, as you start earning more dollars, the things that you can invest in the alternative space opens up. But in the retirement account space, like the Roth IRA, those things start going away. And so as people start making more money, as they get closer to retirement, as they start awakening to the tax reality that we may be looking at in the future and the amount of spending that our government is doing on a yearly basis consistently, regardless of which party's in power, people are flocking to life insurance as a way to get outsized returns for less risk than they would take in the stock market and still have it be in a tax advantaged vehicle that they can access tax-free later on down the road. And so I would tell you that you're probably finding out about this at the right time. And more people are finding out about this asset class and flocking to this asset class for all the things that we have just talked about. In future videos, we're actually going to dive into some real examples and show you what some of these policies might look like. We'll start with whole life. We'll move on to index life. We may even talk about variable life. But if you haven't already done so, subscribe to this channel. Click the bell, that way you can get notified for all the future videos in this series that come out and all the other general educational content that we put together. And at the same time, if you'd like to book a discovery call with us, I'd encourage you to do that. You can go to our website, leveragewm.com/contact-us. And you'll go to a page that looks something like this. This is a calendar application that we use where it shows our real-time availability for a 30-minute phone call just to talk about you, what you're trying to do, what your goals are, and how we can help, because we would love to help. This has been Matt Decker, Leverage Wealth Management, signing off. Until next time.